Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing the second company that Elizabeth brought up, and that is none other than Merck. Now recently she said that she doesn't want to do any more pharmaceutical companies anymore, but you know what, I did promise you that I was going to do Merck, so let's actually analyze this company. So with that said guys, let's get started with this video. Coming into their dividend summary guys, we got a dividend yield of actually pretty decently at 3.16%, which ends up being 69 cents per share for an annual payout of $2.76. Payout ratio is actually 35.45%, which is actually fairly good. However, this is not the payout ratio in regards to the cash flow. We're going to take a look at this in just one second, but just let you know that this is not the full entire story, because companies use their cash flow to pay out the dividend, not necessarily their net income, which is what this is based out of. The 5-year CAGR is at a pretty respectable rate at 8.81%, with 11 consecutive years of dividend growth. Their ex-dividend day is also coming up on September 14th, and their payout day is actually on October 7th. So Merck is actually one of those rare companies that pays out in January, April, July, and October. So it's really on off months. So this might actually serve as a pretty decent one when it comes to a dividend, because, well, you're getting paid on off months. So it's always nice. And of course, as I just said, they do pay their dividends quarterly. Jumping into the calculator guys, we got the ticker symbol of MRK, market cap of $223.8 billion with a PE of 13.54. So it's actually fairly good in accordance to my metric of buying companies with a PE of a 20 PE or less. And well, with the current share price of $88.49, this might actually not be too shabby. Full disclosure guys, before we actually go on any further, I would actually like to show that I do own this company, and a pretty hefty amount as well, at 38.77665 shares. Current amount invested is actually almost $3,000, and they're paying me guys $107 in annual dividends every single year, with quarterly dividends of $26.76, with a total returns of $557.25. So you guys can see that, well, I've pretty much bought this company at a pretty good rate, which I believe guys my average share price is actually $74. So as you can see, I've done fairly good so far when it comes to this company. But let's actually come back here and analyze now the annual dividends per share of $2.76 in accordance to the shares outstanding guys. They currently pay out almost $7 billion in dividends every single year. And if we take a look at the 5-year average free cash flow and we subtract the 5-year average minus this $7 billion, we get their amount of free cash flow that they have left after this is paid out. As you can see, it is not good. It is at $691 million. However, if we take a look at last year's free cash flow, it actually is pretty good at $2.7 billion, which if we actually take a look at these payout ratios, we can see that as of last year's free cash flow, they have a payout ratio of 72.37%. However, the 5-year average free cash flow payout ratio is actually 91%, so fairly high. So very much mind your risk when it comes to this company if you're buying it for a dividend. Now let's actually analyze some fundamentals guys, starting of course with a net income of 5 years ago of $2.4 billion to 1 year ago of $13 billion. That's an increase of 445%, absolutely crazy. And on top of that guys, this graph actually doesn't look half bad. Now obviously the outlier year here is 2 years ago, but 2 years ago was COVID, right? So they probably got a hit because of COVID. Now you're probably saying, Merck is a pharma company, how would they get hit? Well, Merck is a pharma company, sure, but remember, it wasn't them who developed any vaccines, right? I think they were close to making one that was like not oral, that you could swallow, but I don't necessarily know if they got through that entirely, because I think we got the Johnson & Johnson, Pfizer, and Moderna first than these guys. So I think that's essentially why they went down 2 years ago, is because of COVID related number. Perfectly explainable. And essentially if you take away this number guys, you can see really nice increase within the past 5 years. Actually it's so nice. I'm actually going to give this at around like a 90%, just because the fact that this year it did go down, I get it's COVID related, we should ignore it, but it still did affect the overall net income, so it's not a perfect score. Now coming into the free cash flow, the most important of all the profit metrics, because this is the one that the company uses to essentially pay for everything. So free cash flow guys, it is used to pay out the dividend, to buy back shares, to pay down debt, to overall grow the company, and of course to make acquisitions. So Really important for this thing to be positive as well as continuously increasing. And well, it's okay. It doesn't look as good as the net income. 5 years ago of $4.6 billion to 1 year ago of almost $9.7 billion. Increase of 112%. With a 5-year average of $7.7 billion. And the reason why I said it's not as good as the net income is because, well, unlike the net income, this one actually did not surpass 1 year ago's value to the 3 year ago value. Again, ignore COVID, right? But as you can see, it did go from 3 years ago of 10.1 billion to then 1 year ago of 9.7 billion. So it did go down slightly, but it's still significantly better than that of the 4 years ago. So, you know, it's kind of stagnant, but it's still doing fairly good. Overall, I'm going to actually give this, guys, essentially an 80%, just because of the fact that they did not supersede 1 year ago number, just because last year's number did not supersede the 3 year ago number, but it is still looking like it's heading in the correct direction. And now coming over here to the revenue, we got 5 years ago of $40 billion to 1 year ago, guys, of $48.7 billion, increase of 21.39%. And unfortunately, when it came to this, we actually saw a dip in their revenue, not during COVID, but during 3 years ago, where they came down to $39.12 billion, and 4 years ago it was a $42.3 billion. So what specifically caused this? To me, it's not really that big of a deal, because you can see that 2 years ago they did go up to now $41.5 billion, and then 1 year ago they did go up again to $48.7 billion. So it's okay, I guess you could say, but overall I'm actually gonna have to give this a 70, just because of the fact that it is an increase, sure, it is positive, sure, except that, well, the drop wasn't because of COVID, and it took 2 years for them to surpass the 4 year ago value. Coming down to the total assets minus the total liabilities, can this company's assets supersede their liabilities, and hopefully that'll be enough to sustain a recession? Currently, guys, they are at $43.3 billion, and well, this is actually good, sure, but the problem is that within the 5 years, they have not been consistently increasing. So you can see from 5 to essentially 2 years ago, they were consistently decreasing. But then from 2 years ago to 1 year ago, they shot up massively from 25.4 to $38.3 billion. And then, as I said today, a 43.3. So not consistent at all, guys. I'm actually going to have to give this not necessarily a really bad failing score, but a failing score nonetheless. I'm going to give it around like a 60%, just because of the fact that it's not consistent. However, we did supersede 5 years ago's value today. And if we actually take a look at the average total assets, we get around $93 billion. Average liabilities, we get around $60.8 billion. And doing this difference, we get $32.4 billion. But just because the assets can cover their liabilities doesn't necessarily mean that their cash flow can, guys. So let's actually do the exact same thing. Let's take the cash flow year over year, and then the liabilities year over year, and subtract them. Basically, what this is showing is hopefully their cash flow is increasing faster than the liabilities is increasing, and the value gets closer and closer to zero, if not ideally in the positive. Unfortunately, as you can see right here, it is not going in the positive at all, right? It's actually going deep into the negative to, as of 1 year ago, of $57.8 billion. Now, full stop right there. Sure, this looks very bad. However, take a look at this, right? 2 years ago during COVID, they were at $60.4 billion. So they actually went down from 3 years ago, $48.3 billion. But as you can see, they actually went up a little bit by around $3 billion or so 1 year ago. And we can actually see this trend slightly here from the 5 to 3 years ago, where they roughly remained at around like the $48 billion mark. So it's kind of 50-50, you know, it got deep into the red, but it's still not too bad. Now, average cash flow minus the average liabilities, we got around negative $52.5 billion. Overall, guys, I actually have to give this, I just said it's not too bad. I still have to give it a really bad failing grade, so I'm actually going to give it at around like a 50%, maybe even a 45%, though I think a 50% is pretty good, just because of the fact that they are slightly buying it back, but they don't really have a precedent to that in the past, so who knows what is going to happen here. Hopefully, this cash flow does exceed their liabilities. And now looking at the shares outstanding, the metric that unfortunately people don't tend to look at, and companies just tend to just issue a ton of shares because they think that people don't look at it. In this channel, we look at it because it is important. This one tells you how much the company is diluting you as the investor. The more shares a company puts out there, the less ownership of the company you have. And this dilutes your ownership of the company and actually makes the share prices come down as well. So it's really, really important, guys, for this thing to be decreasing. And on top of that, guys, when it comes to companies that pay out dividends, it's also really, really important for this thing to come down, because the less shares that there are out there, the less dividends they have to pay out overall. So 5 years ago, guys, they did 2.7 billion shares to today, guys, 2.5 billion shares. That's a pretty good decrease on the 5 year of 6.06%. However, from the previous year to the current year, I believe that this is looking at 1 year ago of 2.527 billion shares to today of 2.533 billion shares. It is an increase of almost 1/4%. So unfortunately that is increasing, but overall within the past 5 years, it is decreasing, which is fairly good. I'm gonna give this, guys, essentially a 75% overall average. And now lastly, when it comes to the cash equivalents, they currently have $9.7 billion with an average cash of $8.3 billion. So let's actually do a quick recap on Merck. We got the net income at 90%, free cash flow 80%, revenue 70%, assets minus liabilities 60%, cash flow minus liabilities 50%. That could be way better, and their shares outstanding at 75% for an overall grade, guys, of 74%. It is actually really, really average of a company. That's why I essentially like it, because it's neither here nor there. Alright, guys, now let's come over here and make some assumptions. Low, median, high, using, of course, revenue growth, the predicted share buyback, and the required rate of return, which I like to keep flat at 10%. So let's actually analyze this company, guys, starting, of course, with the revenue growth of 6.13% in accordance to Seeking Alpha's revenue growth forward. And the revenue growth year over year is 30.21. Now, guys, as you can see right here, 30.21 is massive. And my job as an investor is to essentially be conservative when it comes to my assumptions. So I am going to say that for the low assumption that they'll make at around 5%, so 1% lower than the forward that the analysts are projecting, 6% for the median, which is in line with what they're saying, and then 7% for the highest assumption. Now, guys, for the projected share buyback, well, we do see that they are buying back shares at around 6% or so. Now, do I personally believe that they'll do again 6% within the next 4 years? Probably not. But we can pretty much just say that they might, assuming the highest assumption. So for the low one, let's actually put this at around 4%. For the highest one, let's say 5%, and for the highest one, let's say at around 6%. So now with that, guys, we do get some target share prices. You can see right here, not adjusting for debt, of $61.08, median assumption $63.87, and the highest assumption, it is $66.76. I think I just realized that I said highest assumption for median one when I was doing the 5% predicted share buyback. My bad, sorry. Median assumption, it is 5% projected share buyback. So that is essentially what we get when it comes to the target share prices, not adjusting for debt. Now, adjusting for debt, the way we do this is we take the cash and equivalents, we add the net debt, and if they have more debt than cash, then this value comes down. If they have more cash and debt, then this value comes up. And as you can see, it does, guys, come down by around $5 or so to now $56.21 for the low assumption. Median assumption, it is essentially $59, and for the high assumption, it is $61.79. Now adding a margin of safety of 5, 10, and 15%. This puts me between the ranges of $47.78 to $53.40 for the low assumption. For the median assumption, it is $50.10 to essentially $56. And for the highest assumption, it is $52.52 to $58.70. So guys, the current share price is $88.49. So as you guys can see by all of this, well, it is pretty expensive right now as it stands. And in my disclosure earlier in the video, I said that I did buy it and my average share price, guys, was at around $74. So you're probably looking at this and you're like, you were way above the current share prices that you have right here, or the target share prices that you have right here. Why would you do that? The reason is because now you have to analyze, are you willing to pay the premium for this company? Because if you take a look at these values, guys, $66.76 to $88.49, that's a pretty big jump, right? That's $20, almost $20. The way that I did it, I was less than $10 away. So I figured, you know what? Let me just take the L, let me take the premium, and let me just pay this money, because I think that Merck is okay in accordance to the overall grade I gave it, right? 74%. It's a pretty normal standard company. It's a fair company overall. overall when it comes to their fundamentals. So I just figured, let's just pay that premium. It's perfectly fine. So just because I give it these numbers, guys, doesn't mean that, first of all, this is not financial advice. And of course, every investment is the present value of all future cash flow. All of these numbers will change if you change any of this. For example, let's say that you believe that they'll do 10% for the highest assumption. Well, now look at this, guys. Now we're at $73.85, assuming that they buy back 10%, 6% of shares, right? $73.85 to now is significantly closer than before. So, you may want to buy this company and take the premium as well. It really just depends as to what you believe this company will do in the future. So because of that reason, I have this calculator, guys, available for free to anybody who wants it. It's in my calculators playlist. Please go there, have this calculator. You make your own assumptions, you come up here, you make a file, and you could put all the numbers you want. You could change the required rate of return, you could change the margin of safeties, whatever, right? You can also, guys, have my book value ratio calculator, my reevaluation calculator, and a dividend tracking sheet, which I just showed all of you guys right here. I do have Merck, and it tracks a lot of good stuff as well. And on top of that, I do have other spreadsheets with this dividend tracking sheet that may help you guys track how many dividends you will get every single month, quarterly, and even annually. So for all of these free things, guys, all I'm asking for in return is just like, subscribe, comment. Thank you so much for the 800 subscribers. I really do appreciate it. All I'm asking for in return is just help me grow my channel. Hopefully we can get to 1,000 by the end of the year. That would be awesome. At 1,000, I do plan on making a really special video showing you guys, I guess I should give all of you guys a sneak peek, showing, I guess, my Roth IRA, which I've never shown, as well as something else towards the end of the video. So if you guys want to see that, make sure to hit that like, hit that subscribe, comment, and of course tell your friends to come and join this community. So thank you again for everybody who has. I really do appreciate it. Now let's actually take a look at this dividend because, well, Merck does pay a pretty good dividend, right? So if you make the average monthly US income of $5,725 at the current share price, if you put in 1 month's income into this company, this would buy you 64.7 shares. And at the current annual dividends per share, this gets you $178.57. Quarterly dividends of $44.64, and a monthly dividends of $14.88. So it's fairly close, guys, to $200 mark, which I consider efficient. Like, that's just me choosing that out of thin air, right? I just personally, I would love to get $200 worth of this company if I were to put in $5,000. Actually, let's test that out. Let's come over here and put one of these values into this and see what we actually get. So we put 66.76. We get, yeah, look at that, guys. Look at how much the dividends annually increase if it were to drop to $66. Absolutely crazy. $236.69 for $5,725. That's really, really good, guys. It really does go to show that when you don't overpay for something, you will definitely get significantly more returns in the future. Overall, when it comes to Merck, as I showed, I do own this company. I do like this company. At the current share price, I see it a little bit expensive, especially for me since I bought it at an average price of $74, right? So at least for me, it's expensive. I still personally like it. The one thing I'm concerned, guys, is this 5-year average free cash flow. But you guys saw the graph. It doesn't look that bad. This dividend, though, I would not be surprised if they do cut it in the future, but hopefully not. Hopefully they'll be able to grow their cash flow significantly more or buy back more of their shares, so that way less of their cash flow goes into a dividend. That pretty much does it for this video. Like if you like, comment, subscribe. As I said, you guys can follow me on my new tech sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.